Good morning, good afternoon, good evening. I'm Nicolas Véron at the Peterson Institute for International Economics. This time I even have the logo behind me. It's my pleasure to introduce this new session of the Financial Statement series. And once again, we'll talk about Russia today. We're not going to be talking about Russia today as a media, but today we talk about Russia and the Russian financial position in particular. The war, of course, has been going on for a number of months, more than a year, soon 2 years now. And we feel it's very important to regularly update our understanding of what that means for Russia as an economy, and particularly the financial system and the financial fundamentals of the country. So I'm very grateful today for the presence of our two speakers. In a way, they have similarities in their profiles. Both worked in Russia, both left Russia at the time when the war started. Now they're speaking from, I think, respectively, the United Arab Emirates for Alex Isakov and Berlin for Alexandra Prokopenko. And they have very deep insight into the Russian economy. Alexandra Prokopenko started her career as a journalist. She studied journalism at Moscow State University, also known as Lomonosov, and graduated there in 2006. She also went into a visiting scholar program in journalism at University of California at Berkeley in 2010, and completed a master's degree in sociology at the Moscow School of Social and Economic Sciences, also known as Shaninka, and at University of Manchester in 2018. She's worked as a journalist at RIA Novosti, at ITAR TASS, which then became TASS News Agency, covering Russian economic policy, head of the desk, and then worked for Viedomosti, one of the more reputable financial and economic media in Russia from 2015 to 17. Then she went into academia at the Higher School of Economics, one of the better institutions in Moscow in this area, and in 2019 joined the central bank. She was advisor to the deputy governor, Ksenia Yudaeva, but Mrs. Yudaeva, like Governor Nabiullina, didn't leave Russia in 22, unlike Alexandra. So since February 2023, she's been a non-resident scholar at the Carnegie Eurasia Center, she's been at the German Council of Economic Affairs, Foreign Affairs, the GAP, I'm confused now, and also a non-resident scholar at the Carnegie Eurasia Center. Alex Isakov studied at the Higher School of Economics as well, where he got his PhD. He worked in the banking sector, and then in 2011 at the Bank of Russia, where he covered monetary policy as an economist. And then in 2015, he went to the Russian, not quite private sector, but the state bank VTB Capital, one of the major investment banks, where he stayed for 6-7 years until 22 as chief economist. Since 2022, Alex had been working at Bloomberg, I'm very confused today, at Bloomberg, covering Russia and Central and Eastern Europe as an economist. So thank you so much. Sorry for my morning confusion. And Alexandra, over to you. And you will need to unmute yourself while sharing your slides. Yes.
Super. Hi, everyone. Sorry for this. Sorry for this little confusion. Nicolas, thanks for your kind. So yeah, it works. For your kind introduction. I would just need to mention that Ksenia Yudaeva stepped down from her position of first deputy governor, and now she's the simple advisor, and she also resigned from the board. So, well, the things in terms of moral choice of Russian technocrats and Russian high-level officials are quite controversial. But we're here to talk about...
Sorry to interrupt. I stand corrected because I didn't know that. So thanks for complimenting what I said.
Right. So, but here we will talk about economy, and I will tell you about, as I calling this, the situation is Putin's impossible trinity. And what we learned from this war so far is that Putin has no limits in terms of casualties, neither human or financial, in path of towards his goal, whatever his goal can be. And well, the war became existential not only for the stance of Putin's regime, which we can define as anything from the catalog of autocracies, you can call it, you name it, but it's become existential not only for the type of the regime, but also for the economy. The government priorities for the 2024 budget are financing the war in Ukraine, spending on security services, integration of occupied Ukrainian territories, and social handouts. As we see from the chart, Russian war spending exceeds 6% of GDP. That's projections for the next year. Well, in the previous years, it was high, but not so high as it's going to. And so together with national security spending, it's almost 8% of GDP. And this is still less than it was in the USSR, but it's still, but it's more than social spending and spending on national economy, which actually decrease combined. So the budget situation looks so for now, and from now, the budget situation looks quite stable. I will talk about this a little bit more. But what we see, but there are limitations in terms of labor market and in terms of manufacturing. So Russian authorities like to talk about a structural transformation of the economy, well, meaning pivoting towards the east. But in reality, however, we are witnessing a structural shift in demand from the civil sector to the expanding military sector. And when I'm talking about expanding military sector, I mean both military industry complex and the manufacturing that serves the needs of the army. What we see here from the chart that a big part of civil industry, electronics, transport, apparel, also beverages, food production, logistics is here also. All this part of industry is growing because of the state spending, because of the state spending money on the war. And this and increasing military industry sector sucking resources, both financial and labor resources from the civilian sector, which, well, benefits economy in terms of current figures of GDP, but in terms of well-being, well, I would argue that it's not. Increasing military
Alexandra, sorry to interrupt again. You're not on full screen mode, and some of the captions of your charts are in small font, so I think it will be better if you move to full screen. That's a little bit better, but you can probably expand it even further so that we only see your slide.
Well,
if you this is already you know, much better than the previous one.
Okay. So here is a chart where we see how mobilization has pushed labor markets off balance, and how labor and how and even this sector and even sectors at whatever and sectors which requires not so many workers, like oil industry or this like oil industry, well, people from there and people from the civil sector, from services, now moving to sectors of the economy which requires lots of labor, lots of people labor, that we see from the chart. And what I also need to point out that increasing military spending not only supports the economy, but also fill pockets of ordinary people, and real incomes rise fastest in regions with significant military industries, or to the people from the regions who live in poor regions, but many people from there were drafted into the army, like Buryatia, Chechnya, Jewish Autonomy Region, and so on. So people there are now getting social benefits from the war because families of those who are drafted getting their payments, or they're getting payments from the state for those who are wounded or dead, and all these payments goes to it goes to the customer demand.
So sorry to interrupt, but just for clarification, that means for a place like Chechnya, for example, you mentioned, this is macroeconomically significant for that region?
I would say, yeah. If we see that the real wages almost doubled, or in some regions tripled,
wow,
because of the war. I mean, if the average, for instance, in a region like Buryatia, and I don't remember the exact number for Chechnya, but it would be a little bit more. So the average salary would be approximately 400. So 40,000 rubles in dollars.
Yeah, we divide by 100.
It's less than $1,000, but the payments which people receive from the government if they're serving the army, they are exceeding $2,000. So you see the gap is significant.
And one more question about this, and I don't want to slow you down too much, but
sure.
In your chart there is a reference to defense and social. Can you explain what that means, defense and social?
Defense and social, defense and security, you mean?
No, go to the next chart.
The next chart, right?
No, the next one. The one you were on. Yeah.
This,
Here there's defense and social at the beginning. Should that read defense and security?
Yes.
Okay. Thanks for clarifying.
Sorry, that's not defense and security. Here, defense and social, it means the public sector. Which includes both, military and the large public sector, which social workers, teachers, all those who get budget money.
Okay.
In general, yeah. So I would say that. About 1/3 of the aggregated demand in the economy is now distributed by the expanded defense sector. And here, as I said, I'm watching on expanded defense sector, which included both military industry complex and sector who served ministry. And to me, the key question is whether Russia's economy is militarized enough that it will collapse or will face another significant structural shock when the war over, or if the war turns from the hot phase, from the clashes at the front line, into the Cold War. Into the Cold War, the phase when the fire will stop, but Russia will need to fulfill its stockpiles, to fulfill its warehouses. So because right now industry works mostly 3 shifts. Because of the needs of the front line. So, but why do they need to work 3 shifts when they will work on the warehouses? So, what's also important that Kremlin expects to fund expenditures in 2024 from oil and gas revenues, and here, thanks to buyers from China buyers of Russian oil from China and India. And the budget is based, from my perspective, on a very optimistic assumption. The average oil price approximately 85 a barrel, and ruble exchange rate 19.1 ruble. So and here we are coming to one of the most baffling part of the budget is very low projected inflation, 4.5% at the end of 2024. Which seems to me quite impossible to reach because the spending increase more than 1/3 from 2023 to 2024. So it seems like partly Russian government expects to pay for these expenditures because of the oil price, oil revenue stream, and because of this low ruble depreciation. The economy is operating on its limits of both production capacity. As I mentioned already, the enterprises are working 3 shifts, and labor resources. Unemployment is on a record low; it's 3%, and it's likely to remain at this level. So, due to inflation, the Bank of Russia is forced to keep monetary policy tighter for longer. We also see signs of inflationary spiral right now after the last rate hike. Large state-owned enterprises asked the FinMin to consider subsidy rates for their loans, not to cut their investment programs. Given that state-subsidized loans already approximately 7% of GDP in Russia. So if Russian government will decide to subsidize new loans for state-run corporations, it would this decision would likely to lead a new surge in inflation, prompting central bank to hike rates once again. So. And here I see the signs of spiral, and it's also brings me to the point that it is a problem of today which Kremlin doesn't actually want to solve. So Kremlin easily sacrificed the future of well-being, well, because high rates for longer, it's not good for the economy, as we know, but for the sake of today. Here, the recent imposed capital controls. So now we're going.
Sorry, I'm interrupting
Yes.
you again, but just on the previous
Sure.
slide, this may not be familiar to everybody watching this program. In the last few weeks, there has been a considerable increase in policy rates, right?
The latest board decision was to increase the rate. So the step was quite significant, 2 percentage points, and it was from 13 to 15, as far as I remember.
But what I mean is, if I read the chart correctly, there was a big spike in policy rates at the beginning of the wars, and things came almost back to normal. And then
yes,
in times they have increased a lot again. Can you remind us what triggered that spike in policy rates in recent months and weeks?
And there was an unexpected rate hike in August, which were forced by the increasing ruble exchange rate, which were disturbing Kremlin and government, and that's and then that's the point where I wanted to jump in my next thesis. Because so first, well, mostly the ruble exchange rate right now is. So what we witness now, it's a kind of the fiscal dominance. The ruble exchange rate now is more a function of government spending and capital outflows. And because ruble without the budget rule and because of the sanctions, ruble exchange rate is more determined by trade balance. We saw depreciation of export income and increase in imports, which triggered the weakening of ruble in July, August, and forced central bank to do the first rate hike. And then we witnessed the second rate hike just recently. And recently, Russian government imposed capital controls, and it was mostly the decision by the government. And so if we imagine Russian central bank as a right hand and Russian government as a left hand, the left hand just won the battle with its right hand. For Putin, strong ruble means not only the strong economy, but also the social stability. People are quite worried about 3 digits in exchange rate. So capital controls was more, so to me, it's considered more as a tool for the government to calibrate the exchange rate faster than it calibrates itself because of the movement of because of the decision of the central bank. So a high key interest rate is not comfortable for the government either. but it's as I said, for Putin, it's not the problem of today. So currently, they need to see double-digit exchange rate because Putin is going to announce that he is running for election in March 2024, and probably he will win this. And he needs a very favorable picture of the background because he definitely will use the narrative that Russian economy is well winning the war against sanctions. Russian economy is stable, so that's why, and it's quite complicated to do when you have three-digit exchange rate and double-digit inflation. Well, at least in food inflation, along with coming back to capital controls, along with the recent imposition of export tariff for non-oil exporters, which they were imposed in the early October, it seems that Russia is moving away from market-based system of state capitalism, as we know that, and well, it's naturally going towards a mobilized wartime economy. And mandatory sale of foreign currency earnings provokes devaluation sentiment and, as a consequence, fuels inflationary expectations. Well, if governments are doing something because of the ruble exchange rate, people feels that something bad will definitely happen. And this provokes, as I said, inflationary expectations. And the destruction of ruble's reputation leads to dollarization of savings, I think we will witness now, and because people will think that that's a good way. Yeah, that's a good time to buy dollars. Therefore, I think that well, Russian government will add some more capital controls. Probably they will ban withdrawals in rubles, or they will ban withdrawals for ordinary people, because so they need to create some sort of Russia is a safe space, ruble is a safe space, to restore the trust to ruble, which seems quite impossible to me. Right. So any additional restrictions, as we know, would be extremely harmful for long-term financial and macroeconomic stability, but who cares about long-term, because Putin has the elections in March. And my third point, I'm coming to the end, relates to decision-making process. Putin seriously believed that much of the collapse of the great, from his point of view, empires like Russian and USSR, Russian Empire, I mean, he was due to poor financial management. That's why he probably previously he was along with the market economy and with the very high with the professionals from at the financial leadership. So and I would say that two major pillars of Russian financial success, well, we can call it success, of the last year and this year are anti-crisis management conducted by central bank and Ministry of Finance, and of course current account surplus and extra revenues that Russia get from oil and gas and the last year. But we also can witness a very interesting paradox that in Russian authoritarian state, Russian central bank, well, before the imposing of capital controls, act independently. And that's a paradox. But success is often come to vertigo, and again, speaking about success, I'm speaking about the success of in 2024. And I anticipate that probably some more bad economic decisions we will see, maybe probably some extra spending because Putin will need to make extra payments for people because of the elections. Or, as I said, probably it can be some more capital controls. And the central bank alone cannot sustain the all damage that can be brought to the economy by these bad decisions. So I would say that the current situation in Russian economy is quite stable, but very fragile. And in terms of external risks, the major risks can come only from oil oil prices, because Russia is quite isolated by sanctions from the other parts of financial external shocks. But we can see the raising probability of internal shocks, and one of these internal shock is a vertigo from the success. So, well, this year, I will also need to mention that this year suboptimal decisions made Russia to abandon very good, well, probably good working institutions like predictable tax system and property rights and budget rule. And so, as I said, in midterm, it seems quite bad. And in the short term, well, say stable, solid, and I believe me, Putin will say that Russia is resilient and sustainable as it never was. So, but to me, it seems like Putin's impossible trinity is to maintain macroeconomic stability, which is undermined by bad economic decisions, to maintain the appearance of reciprocal contract, well, business as usual, and allow people and business as usual and some sort of investment climate, so economy continue to function and finance the war, so increasing spending. And okay. I don't feel how Russian authorities will sustain all this stuff in the upcoming future. So here I'm coming to my end. Thank you very much for your attention. Yeah.
Okay, you can unshare your screen, and Alex, over to you.
Yeah, thanks. Thanks. I'll try to complement what Alexandra said and to make a little bit of like counterpoints. So my background is mostly in markets, and so my comments will be mostly about like budget sustainability and actually financial restrictions, or whether there are any kind of financial limitations on Russia at the moment. So as we've seen from Alexandra's charts, so I try to split my points in three things: the external financial limitations, the limits to domestic capital and borrowing, and like what are resources, like untapped resources for Russia to loosen external financial restrictions. So firstly, external. On the external front, Russia remains a current account surplus country, right? On our estimates, this year, Russia will incur around $70 billion of a current account surplus, and this will probably be true for the next like foreseeable future. So we expect that Russia will continue to be a current account surplus country. External debt external debt redemption profile for Russia is also like not very restrictive. This year they've repaid around $3 billion, and they've used some of the remaining international resources under central bank's control to offset the effect on the local domestic FX market from that redemption. For the next couple of years, the pressure will be even lower. So next year, Russia will only have to repay less than half a billion dollars in Eurobonds, and for the foreseeable future, it will be between 3 and 4 billion redemptions per year, which is low compared to GDP, low compared to even remaining international reserves, and very low compared to the current account. The external pressure is just not there from the financial markets perspective. On the domestic front, Russia enjoyed a pretty substantial period of capital inflow before the war. Between 2015 and 22, the participation of foreigners in the domestic sovereign debt market has been steadily rising. At one point, Russia has been one of the most like foreign-owned domestic sovereign debt markets in the world, and that reduced Russia's cost of borrowing substantially. There was a point where 10-year yields in Russia were not very far away from where US yields are now. like basically 6% 10-year yield for sovereign debt local currency borrowing. Now the situation is completely different. Long-term yields are around 12%. This substantially reduces Russia's fiscal space structurally over the long term, but we need to kind of understand where we are starting. In 2021, Russia's debt to GDP ratio was 13%. This means that to reach a point where either debt service or debt to GDP ratios will start to fiscally bind the country, we are just years from now. So Alexandra has a nice chart there which shows that in a variety of interest rate scenarios, we are going to see the debt to GDP ratio raising to 30% by 2030. So basically in the next 5-7 years, so not tomorrow. Lastly, so again, domestic financial market allows Russia to kind of increase the debt to GDP ratio for some time. Yes, the fiscal space is lower, but it's still in place. Lastly, there are there are those parts of savings which Russia has not tapped into yet, and this primarily I think is the domestic equity market, domestic stock market. Russia has not been doing any substantial privatization for many years. I think it stopped privatizing its like state-owned assets in the middle of 2010s, but that doesn't mean that those kind of assets ran out. If you look at state ownership of say military sector, it's very heavy, and given the profile of given the fact that the external capital outflow is increasingly restricted, both, as Alexandra said, by domestic regulation, which cracks down on capital outflow, introduces capital controls, but also externally by rising risks of sanctions. And we see this strong fiscal impulse. This means basically that a lot of state-owned assets will be kind of profitable for the foreseeable future, as long as military spending remains high. So just as a benchmark, we've seen around $30 billion of an increase in household deposits abroad just last year, which is like more or less like a little bit more than a half of total current account surplus for this year. And I think the next place Russia will be looking for funds is to try to privatize, sell more of state-owned enterprises on the open market, attract domestic savings, and thus like essentially balance the reduce capital outflow, reduce pressure on ruble, and get the money for its current spending without causing too much inflation.
So if I understand you correctly, your thesis, buttressed by Alexandra's slide that we see on screen, and after that you can share, Alexandra, is that all those domestic households, people who have money to invest, they might be attracted into investing in defense industry and banking shares, as opposed to putting their deposits abroad in dollars or euro. Is that what you're implying?
Yeah, I think so. So our big picture kind of story on Russia has been for some quarters already, is that what we are seeing is very similar to what happened in South Africa in the 80s under sanctions for the apartheid regime. And what happens is that when a combination of domestic capital account restrictions combines with foreign financial sanctions, which kind of increase the risk of asset freezes abroad, etc., what you see is a domestic kind of asset price inflation. And also this kind of makes the valuations of the domestic stock market pretty attractive. And this stimulates also like...
But I mean, yeah. Alexandra, can you please unshare your screen so that we can see the speakers? My question about this is that plausible? Because I guess Russians put money abroad because they don't trust the future of the Russian economy. So isn't that a kind of overriding concern, even if you have an attractive ruble assets on the face of it, you know, a share of a company that's making a lot of profit because of the war? If your decision criterion is to just put the money abroad because you think Russia is unsafe, can it offset that consideration? That may be a stupid question.
No, it's completely spot on. The question is completely spot on. The capital outflow is driven by a risk diversification kind of thinking, and the fact that you really need to diversify from the country risk, right? But at some point, but this works only if your own risk is kind of uncorrelated with the country risk, right? But when the capital account restrictions either explicitly forbid capital outflow, or the sanctions become so broad that there's essentially like there's 100% correlation between your risk, and the country risk, that kind of reduces the rationale for this diversification, right?
Okay. May I add a little bit to this that if you will watch the numbers of people who started making their investments in recent years in Russia, it was significant. I mean, before the war, Russian financial market was people's investments. I mean, ordinary people was a factor of growth, of expansion of Russian financial market. So it wasn't one of the reason of Russians invested abroad was, as Alex said, was diversification of their investments, but people also trusted in Russian financial market. And if we see now on this, people are still there. People are still investing in Russian companies, and and this kind of investments are attractive to them because they bring them. Because they let them earn more than other financial instruments. Right. Yeah. So and people get some taste to this kind of investments. So I would say that people's IPO of Rostec or Kalashnikov, it's not an impossible thing right now. It's not unthinkable because people get used to this kind of stuff.
Of course, Kalashnikov is a household name, but Rostec is another weapons procurement company. Okay.
Yeah,
yeah, go ahead.
Yeah, exactly. But currently, Russian military industry complex is state dominated, so it's mostly funded by budget, by state budget. But as Alex mentioned, people's IPO on the closed market because you don't have actually non-residents on the Russian market, so it's quite isolated from this so-called non-friendly investors. It can be a place where they can get some extra money, and I think people
by non-friendly investors, you mean foreign investors, right?
I mean not only foreign investors, but I would say that Russian government now conducted the legislature which divide countries on friendly and non-friendly. It is not it is a term. So there is a decree. It is.
So let me try to understand. Are India and Brazil friendly or unfriendly?
India and so it is. So if you are no, India, Brazil are not in the list. So they are not in the list of unfriendly. But okay. It's
so unfriendly. Unfriendly is more or less the people who have applied sanctions, right?
More or less, yeah. But it's but because it's very untransparent regulation, I would say that because a couple of countries find themselves in the list because the
list is public, right?
The list is public, but the process how countries getting into the list is completely non-transparent.
Okay.
Yes.
Okay, Alex, was at the end of your initial remarks. We're a bit late on schedule, but this was super interesting. You're on mute, but I take that. Yeah.
Yeah, thanks.
Okay, by the way, the slides of Alexandra's presentation will be uploaded as usual on PIIE.com, so lots of interesting data there. I have a couple of follow-up questions, some of which come from the audience. Well, some people in the audience ask questions which are of a general nature about, Western support to Ukraine, Ukrainian financial positions. They're not really what we want to focus on today, because we have done and we will continue to do other sessions of this series about Ukraine, but here we really want to concentrate on Russia, and that's our topic. There are questions, however, which are related to Russia on the famous issue of the foreign reserves of the Russian central bank. And of course, as both of you worked at the Bank of Russia, you know a lot about that. So as is known, there's been reported 300 billion or so of reserves immobilized. Is that a factor in the analysis of Russia? My impression is that everybody in Russia has kind of written that off and is not counting on this money coming back anytime, at least as long as Putin is alive. But is it debated at all?
As far as I know, no, it's not a part of the debate. So most part of the government are get along with the idea that this money will never comes back. But because we see how the West is reluctant to transfer these funds to Ukraine, because it brings the bad precedent to the system, and central bankers it is opening a Pandora box for other cases of seizing assets, and for maybe coming up cases of seizing assets. So probably I will anticipate that this sum can be used in possible talks if we will witness them. This amount can be paid by Russia to whatever. But I wouldn't say, but it's not a part of the debate. And of course, Russia is still counting this this amount and this as a part of its reserves, because technically it's just frozen but immobilized, but not
exactly. So it's in the reported numbers, but nobody is expecting it to come back.
Nicolas,
yes.
Alex? Can I add to this? I think there should be a clear distinction between I think this debate on international reserves should start at the purpose of international reserves. The impact of the international reserve freeze is deeply related to the question why countries actually hold or accumulate international reserves. Typically, there are two reasons to hold reserves. First reason is an insurance against sudden capital flow stop, just to plug the gap in the capital outflow. And this is not what Russia experiences, because they've actually frozen the foreign investors' holdings in financial assets, and thus they don't need to offset, at least for now, this flow. The second reason is a monetary policy, essentially, extension of your monetary policy. You need reserves because you manage your exchange rate, and you use FX market operations to do monetary policy. And Russia actually doesn't need those reserves for doing that, because one, the exchange rate is freely floating. So more or less it's open market, freely floating exchange rate. So you don't actually need to do open market operations. And second reason, I think domestically, the strong belief is that you can use monetary policy as defined as just changing the interest rate and fiscal policy stance to stabilize your economy without the recourse to international reserves. So you can use just orthodox, conventional monetary and fiscal policy to stabilize your economy.
Without intervention. There's a question from Victor Castro on whether Russia has any available liquid reserves besides renminbi and gold. Victor mentions NFW liquid assets, but I don't know what that acronym stands for.
That's a National Welfare Fund, and
National Welfare Fund. Thank you.
Yeah, so there are in liquid assets, as far as I remember, they're gold, they're yuans. Russia sold. I think they get rid of other currencies. I don't remember the last their last disclosure. Alex, can you add something? I think that in liquid it's yuans and gold.
So before the start of the
war, that's not the most liquid stuff, yuan and gold, right?
I think to answer this question directly, yuan is a liquid asset from the Russian perspective. At least at the scale that Russia uses yuan, there are no kind of liquidity constraints on the use of yuan as the Russian reserve asset. In terms of gold, I think it's also pretty liquid. When you want to kind of convert it in any currency, in which you can transact, such as yuan or dirhams or even dollars to euros, the kind of margin is pretty thin on conversion. So I think it's also pretty liquid. Otherwise, in terms of currency structure, before the war, Russia actually bet big, I think, on Europe, in a sense that it converted most of its reserves out of dollars and put them in euros. So most of
that's why they have 200 billion at your clear or so.
Yeah, exactly.
But that raises the question of de-dollarization. So let me ask it in completely stupid, simplistic terms. On a scale from 0 to 100, so 0 would be a dollarized economy and 100 would be a fully de-dollarized economy. Where is Russia now on this transition?
Well, I would say that somewhere at 60.
So it's a long way towards
it was a long way towards it is still a long way towards full de-dollarization. Dollar is the third currency for a population. The private corporate still has dollar nominated foreign debt, and some of them got special permission to pay interests and to make to make payments, so there would be no defaults. No.
Sorry, for clarification, when you say households have denominated foreign debt, is that in Russian?
Not household, corporates.
Oh, corporates. Okay, and that's in foreign.
Some in foreign, in both in Russian and in foreign. Yeah.
Okay, thank you.
So, central bank after 2014, as far as I remember, central bank realized that the level of dollarization of the economy is extremely high. So they put steps. So it was some sort of a policy from the regulator to de-dollarize the sector. But yeah, so it's still a long way to go for the 100%. But it's the dependence on dollar reduced significantly. So and yuan basically for transactional purposes, Russian corporates and Russian state using yuans as a dollar. So there was once so one currency was substituted by another one simply, and well, for now it works. Without any additional transactional costs on the economy and on the economy in general, and in particular on the corporates, and even people started to saving in yuans. There is an interesting thing that there is a very interesting thing with yuan, because it's not technically it's not CNH, so it's not offshore yuan from the Hong Kong. Thanks to the role of Chinese clearing banks. But there is an issue we need to investigate a little bit more. That's more related, not about the Russia, but more how China using yuan in terms of substitution of any reserve currencies like dollars or euros or so. Because
I'm not sure I understood this. Is that related to SIPs, or what is the kind of things that you refer to?
So originally, if you're using offshore yuan, it is CNH, so yuan from from Hong Kong.
Right.
But in Russia, it's not yuan from Hong Kong, it's from the mainland, which means that there are other clearing banks in Chinese financial system who are allowed to do this kind of transactions. Is it SIPs or no? It is an issue I need to investigate a little bit more, but I think it's definitely an issue we need to watch closely, not only in terms of Russia, but also in terms how China is managing using yuan as a substitution, as a reserve currency, because, well, you're probably familiar with the approach of Barry Eichengreen, that China is not going via reserves, via growing the share of yuan in reserves, but via growing the share of yuan in trade. And here is the issue.
Very interesting. Alex, on de-dollarization and yuan?
I think, if you look at the data on the exchange rate, foreign exchange turnover on the Russian stock exchanges, then definitely yuan went to the first place. Like, this is the largest turnover there. And if you look at the settlement of trade of imports and exports, there's some progress. In the simplistic scale, I would say that we are at 30% de-dollarization.
Sorry?
From this 100 to 0, I would say we are at 30% de-dollarized for Russia. So this is still early stages.
Very interesting. Related to that, I have a question about the remaining Western banks in Russia, and of course Raiffeisen comes to mind. It's not the only one. It's probably the biggest at this point, unless you correct me. What role are they playing in the system? Are they still important? Would it make a difference if Raiffeisen was finally leaving Russia? How should we think about that? Maybe Alex first.
So in terms of foreign presence, there are at least 2 large European banks which are included in the list of systematically important banks. So they definitely play a large role.
So you mean Raiffeisen and UniCredit, or?
Yeah, definitely. Yeah. In terms of their role, I think they are an important kind of payment link, settlement link for Russian European Union trade. But I think that we, over the last 2 years, kind of always tended to overestimate the effects of various sanctions and underestimated the system of the just the broad market economy to adapt. And my feeling is that as long as there's a wide-ranging kind of effort to open current accounts by Russian banks in as many currencies as possible, in as many jurisdictions as possible, and to kind of use any other countries to settle trade. This means that the trade, Russia, essentially experiences a tax, a certain tax on settlement, because the settlements become more costly, but this is like a level shift. So
right.
it generates one-off inflation, prices go up, but then the effect just dies down, what we've seen in the last 2 years.
So, Alexandra, do you want to add to this?
I can just add that the SWIFTing was quite painful, both for Russian financial system and for Russian corporates, and it brought a lot of transactional costs for Russian corporates, because they were forced to looking for new ways to do the settlement, to set up any other settlement facilities. But so I think that the presence of foreign banks, especially European banks, is quite important. That was the reason why I think Russian authorities forbid to sell the assets. I mean, it's not, well, Raiffeisen would be a bad example, because it plays a very crucial, it plays a significant role in domestic market. It's quite a big lender in domestic market and in terms of consumer banking. But There was an example of Intesa and the Intesa deal. It stops twice, as far as I remember, and only I think in this autumn they've got the permission. So because and for Russian authorities, that this presence was important because these banks wouldn't be sanctioned. So they still be linked with the global financial system, and the transactions would be possible. But from my perspective, I still think that current financial system, the global financial system and global banking system still can make some sort of facilities for Russian money, for non-Putin's money, but Russian money who can, well, who could be withdrawn from the country, and this means.
So just to understand, what you imply is that it's good that these banks are there because they facilitate capital outflows?
Yes. Yes, okay. and I think that stimulation of Russian capital outflow would benefit Europe and would benefit the sake of sanctions more than completely the swifting of Russia, because well, Russian banks are, as Alex mentioned, already established a sort of accounts in different kind of banks. So it would be costly for business, but it would be more beneficial in terms of sanctions if the West will stimulate capital outflow and brain drain from Russia.
That's a bit of a new perspective on this issue for me. I have we're close to the hour. I just have a clarification question on something you said, Alexandra, about bad policy choices this year. When you mentioned the rate increase that was kind of imposed on the Bank of Russia, so you mentioned, the left hand and the right hand, because Putin doesn't want a triple-digit exchange rate. Did I understand correctly that that was not what the Bank of Russia wanted to do?
So the mandate of Bank of Russia requires from them to do anything for the sake of price stability, which means low inflation. And the big reason and the major reason of the inflation in Russia is state spending, which makes another hand of the government, not of the government. Central bank is quite independent, which on FinMin. So here in Russia we see the classic that. A monetary policy and the fiscal policy now are controversial, and because a central bank is not in the position to stop state spending, and even FinMin is not in the position to say no to increasing military spending and so-called import substitution. What they're doing, so central bank is forced to keep interest rates high. That's not to tame inflation, but it's not what central bank keeping and become the point of the hate of the real sector in Russia, because the rates are high for corporates.
Right. So FinMin, of course, is a finance ministry. So if I hear you correctly, what you mean is that this was an independent decision of the central bank, but which they took with sadness, because that's imposed by government spending policies that they don't approve of.
Of course. And now central bank is under great pressure from the government and from corporates, as I mentioned, that they asked to subsidize their loans because of the central bank. So they're putting all the blame for their lousy position on the central bank. Yeah.
Alex?
Yeah, just can I add to that? I think what will be just very, very beneficial and will just improve the forecasting performance of all of us if you just apply the normal macro perspective to this. So to Russia, there's nothing magical, nothing special there is happening. What is happening is a large fiscal stimulus, the fiscal impulse is close to 4 or 5%. The same one Russia had during COVID, and the interest rates response, the monetary policy response, is just proportional if you plug all this data into your Taylor rule for interest rate, and assume that Russian neutral rate is around 8%. You will have nothing will be unpredictable. This is all in line with your just standard monetary policy model based on the Taylor rule.
But just to clarify this, the decision to increase rates, which again was pretty striking in your chart, Alexandra, in this year, was a logical monetary policy decision and was not imposed externally by the imperative to keep the foreign exchange rate at double digits, correct? In your understanding?
If you can I? So basically the logic is you've got the 4% inflation target. The run rate of inflation in Russia in September was more or less 15%, so not year on year, but the run rate is 15%. If you kind of account for the fact that in order to stabilize inflation, you need to a bit overreact to the deviation from the target, you'll get 15% that the CBR kind of the 15% policy rate that they set. So there's no magic there.
Okay, Alexandra.
No. Alex said everything. I completely get along with him. Yeah.
Thank you so much. This was very enlightening. I had a number of questions on the Q&A from people who wanted you to comment on the US and Europe and the support to Ukraine and the war in Gaza and things like that. I apologize to those who asked those questions because, again, this is not our focus in this session, but we'll come back to related issues in future sessions. But this was on Russia, and I for one, learned a lot of new information. So thanks so much, Alex and Alexandra. And with this, this session is over. We'll have the next session in 3 weeks, not 2, because of Thanksgiving in the US. Thank you very much.
Thanks, Nicolas.
Thank you.